How have credit scores impact mortgage rates in 2025 and what's changed? Today, we're talking about something really important if you're planning to buy a home or refinance: your credit score. Hi there. By the end of this video, you'll understand why your credit score matters, what's new about mortgage rates, and how to use this knowledge to save money on your loan. Let's start with the basics. Think of your credit score as your financial report card. It's a number between 300 and 850 that shows how reliable you are at managing money and paying back loans. The higher your score, the better it looks to lenders, like banks or mortgage companies. When it comes to getting a mortgage, your credit score plays two big roles. First, it determines whether or not you can even get a loan. Second, and just as important, it affects your interest rate. Interest is the fee you pay to borrow money, and it's added to your monthly mortgage payment. The better your credit score, the lower your interest rate, which means you save money. So, what's new in 2025? There have been some changes that make your credit score even more important than before. For one, the credit score cutoff for the best rates has shifted. In the past, a score of 700 might have gotten you a great rate, but now, you might need a 720 or even a 740 to get those same rates. This means even small improvements to your score could make a big difference. Another change is how lower credit scores are affecting rates. In 2025, the difference in interest rates between someone with a high score and someone with a lower score has grown. For example, if your score is below 620, you might pay up to 1% more in interest than someone with a score of 740 or higher. Over a 30-year loan, that could add up to tens of thousands of dollars. Lenders are also using updated credit scoring models like FICO 10T. These new models look more closely at your recent financial habits, especially over the past 2 years. If you've been paying down debt or managing your credit responsibly, this could help your score. There's some good news too. Many lenders are offering more flexibility for first-time homebuyers. If your credit score isn't perfect but you have other strengths, like a steady income or a bigger down payment, you might still qualify for a competitive rate. Now, if your credit score isn't where you want it to be, don't worry. There are simple steps you can take to improve it. Paying your bills on time is the most important thing you can do. Late payments can really hurt your score, so set reminders or automate payments if you can. Another tip is to lower your credit card balances. Lenders like to see that you're using less than 30% of your credit limit. For example, if your credit card has a $1,000 limit, try to keep your balance under $300. It's also a good idea to check your credit report for mistakes. Errors can happen, and fixing them can give your score a quick boost. Finally, avoid opening new credit accounts unless you really need them. Every time you apply for credit, it can temporarily lower your score. So, why does all this matter for your mortgage? Let's say you're applying for a $300,000 loan. If your credit score is 760, you might qualify for a 5.5% interest rate. But if your score is 620, you might get a 6.5% rate instead. That difference in interest could mean paying about $200 more each month, or $72,000 more over the life of your loan. That's a huge difference, and it's all based on your credit score. Now that you know how credit scores impact mortgage rates and what's changed in 2025, you're better prepared to make smart financial decisions. If you're thinking about buying a home or refinancing, take a moment to check your credit score and see where you stand. If you have any questions or want to explore your mortgage options, we're here to help. Reach out to us, and let's talk about how we can make your homeownership dreams a reality. Thanks for tuning in, and I'll see you next time.